should be like failing.
Yeah.
M&A?
M&A, yeah.
That was like way better than I thought it was gonna be.
What? No. Yeah, I was quoting.
Yeah, that's what I stuck, because there was that one problem that she was like, oh, this is going to be on the exam. So I studied that and it wasn't.
Oh, like I just didn't study it because I was like, I'm just gonna like I know all the qualitative stuff and like the quantitative I can like kind of. I probably won't get it intuitively, but why not just give it a shot? I don't know.
The like last one and the last three response I was kind of like iffy about. Because I didn't really like study cost method very much.
For the short answer,
I was like, yeah, I get it. And then I was like, wait. I was like dividends. And then I was like, I started overthinking like, dividends.
I just said dividends and then cash. Like that's just what I put. Like debit, dividends, credit, cash. I was like, make it simple.
Wait, was there a journal entry?
I thought there was. Wasn't there?
Was there a journal entry?
I thought there was.
I didn't do a journal entry.
Oh, okay.
You had to compute. Yeah, that was for the second one.
Oh, okay.
I didn't do any journal entries for
It's so bad.
the cost method.
Okay, good morning, everyone. We're going to finish up our outbound planning first, and then we're going to jump to some topics that are common to both inbound and outbound. Semester on that. So I want to revisit our case 7. So this was, we have a 30% tax rate for our foreign investment for our destination location from our U.S. investment, but then we're going to repatriate with deductible payments. We got $3 million of interest and $2 million of royalties coming from the high tax jurisdiction of the U.S. And so effectively what we're doing is we're moving this $5 million of earnings from the foreign jurisdictions, so coming out of that country in the form of a deductible payment. That is a deduction in writing at the local tax base of $5 million. So we lower our foreign tax burden down to $1.5 million, but the $5 million of deductions taken in country H has to go somewhere. So they become income in the U.S. That's the $5 million that we repatriate to the U.S. Obviously, that's taxed at 21, so we pick up $1,050,000 of U.S. tax. Add the two together, we got 2.55 million, 2.55 worldwide effective tax rate. So, and keep in mind here that this 1.5 million is no longer taxed in the U.S. again because the net CFC tested income regime is only looking for low tax foreign earnings, and that low tax is 14% or below. We will bump those foreign taxes up to 14%, but if you're already above 14%, there's no additional U.S. tax to be paid. So the takeaway from here is that our 25.5% worldwide effective tax rate is a blended rate because we moved $5 million from country H via interest and royalty deductions at 30% to the U.S. and made them taxable at 21%. That pulls us up from 21, but keeps us below 30. That's why we landed at 25.5. And we're going to talk about transfer pricing in a few minutes, but the interest in the royalty payments, obviously they factually have to be there. So, right, you can't pay interest unless there's been a loan. You can't be a loan unless somebody needs to borrow money. So, part of our funding for this foreign investment, we have capitalized Forco in this example with debt in part, and we give rise to the ability to pay interest in the future. And on the royalty side, we have to have factually some intellectual property that the U.S. owns and is licensing to the foreign subsidiary for their use in their business in order for them to pay us. Not just factually, in the transfer pricing rules, we have to price the debt service on interest and the royalty rate based on arm's length pricing, which is what would USA Co. Lend to a foreign party and license to a foreign party that is unrelated at what rate. So that has to be listed in here. Okay. So now, I don't believe Genevieve, she's running late today. So if anybody wants to do case 8. Okay, I'll do case 8. So now we have a low tax foreign country, and we're base eroding, moving profits from the low tax jurisdiction via the same interest and royalty payments, and we have a tax treaty situation between the U.S. and country L of Forco. So The treaty rate provides for a 0% rate of withholding on interest and royalties, so that's nice and clean. I believe yes, we didn't have withholding tax on the prior example either, so we're still getting our interest and our royalty payments out of four coast country jurisdiction up to the U.S. without a withholding tax in a foreign country. And we pay half of our pre-tax earnings out as interest and dividends. So here we have the same mechanic. We have the $5 million moving from the tax base of Forco to the tax base of USA Co. And that's going to be taxed at the same $1,050,000, but now my deduction of the $5 million is only worth 15%. Now I'm pulling money out of a low tax jurisdiction relative to the U.S. I'm pulling it out at 15% and moving it to the U.S., which is taxed at 21%. So that's negative tax arbitrage, if you will. I'm moving income from a low tax jurisdiction up to a higher tax jurisdiction. And so that's going to move my effective tax rate to 18%. The reason that it's less than the prior location is because the money that's left behind, half of the Forco earnings are still taxed at 15%. So that's going to pull me down from the 21%. But not as much as it could have been if I didn't have the space erosion payment. If I could have had all that income taxed at 15%, I would have been at 15% instead of the US. But this goes to show you, yes, that movement of funds might be factually required, because if I lend to them, I have to charge interest. If I license them, I have to charge a royalty. That's the transfer pricing stuff we're going to go through in a moment. But it also illustrates that I might have to suffer some tax cost just to get the cash to the right location. Right? After I make money in Forco, I might want to have some cash in the United States. Getting $5 million, half of the earnings up every year at a somewhat higher tax rate than where it was taxed, maybe a cost of doing business. Cash in the right location. Okay, so it's 18% because the $5 million stays behind and taxed at 15%, but I move half of those earnings from 15 to 21, so I land in the middle. Right? As the same with case 7, the facts, i.e. that give rise to interest alone, and the facts that give rise to a royalty, a license, have to be present, and I have to abide by the transfer pricing requirements to price those, the compensation for those activities at arm's length. Oh, and I haven't mentioned this yet, but whenever you try to take a deduction in the local jurisdiction and the payment is going to a related party, typically the U.S. parent group, if you're in an outbound investment situation, you need to look at the local country's rules for the amount of interest and royalty deduction that's allowable. Remember we talked about 163J? 163J is the U.S. Limitation on interest expense, and it's 30% of EBITDA. Rules like that are common around the world. So if our interest payment, which is $3 million here on $10 million, that's 30% of EBITDA. If you think that the income of foreign interest and royalties is the base for the foreign country, if they have a similar 30% threshold limitation, then we would be right at that threshold. But we'd have to check that. It could be lower than that. They could be 10% of EBITDA. They could be some kind of debt equity ratio. However they want to look at the limitation, we have to cover that to make sure. That would raise our effective tax rate, right? If I have a limitation on the deduction side, that is going to cause the 15% tax rate here, the base, to go higher, right? Because I'm going to lower my deduction. And it won't change the U.S. side, because if you're limited on the deduction side, the income jurisdiction is not going to give you an automatic offset for that, right? I know of no country in the world that makes a limit on the amount of income that they include. So 100% of the interest would be taxable, even though it might be limited under the foreign jurisdiction. So this goes to the point where you need someone on the other side of the transaction advising the transaction, the parties as well, so that you can understand the full, make sure your modeling is correct. Because if you did this model and somebody finds out later, oh, your interest expense is non-deductible in part, throw off your number. You gotta make sure you get local country advice as well. Okay. Case 9. Anybody want case 9? Go ahead. guys would warm up.
So, Forco is located in Country L, and USACO elects to treat Forco as a disregarded entity for US tax purposes.
That means we file a check the box election, and it means a few things. Forco is an eligible entity, which means it's not the highest form of corporation in Country L. And so we make the election, so then the dotted circle in there means it's treated as a branch for US tax purposes. In Forco's jurisdiction, Country L, it's still a corporation, right? That's the hybrid nature of this. So this is a hybrid entity, corporation locally, corporation for all other stakeholder purposes, but for US tax purposes solely, we see it as a branch.
So, USACO incurs current US income tax payments on Forco as they flow through the US has tax returns because of the check the box election. And so basically the foreign income tax is that 15% of the 10 million, which leads to a 1.5 million foreign income tax. As they're not distributing any earnings, there is no foreign withholding tax.
Yep.
And then for the US tax, because that 15% is less than the 21, and it's being treated as a foreign branch, then they pre-credit US tax would be 2.1 million. And then they have that 1.5 million foreign tax credit, which leads to a $600,000 US income tax. And therefore their total taxes, when you add the two, are 2.1 million, which leads to the worldwide effective tax rate being 21%.
Yeah, so there's a lot going on here that's really important to make sure you do not miss. So I paid 15% in the foreign jurisdiction. The mechanic, remember, of the foreign tax credit is the US wants to see you pay 21. And that 21 can be paid entirely to the foreign jurisdiction or partly to the foreign jurisdiction and partly to the US, which is our facts here. I paid 15% to the foreign jurisdiction, which the US credits against my pre-tax foreign tax credit of 21%. So I have an incremental 6% to get to the rate the US wants to see paid globally. So I have to write a check to the US government for $600,000. That gets me to the 21% worldwide effective tax rate because the US took the foreign earnings and boosted them up to the US rate. And that's because this is a branch, and we tax branch income to 21% because it automatically flows through to the US. Right? I might have been able to get to a lower rate of tax if this would have been a corporation. Because if it was a corporation, right, the net CFC tested income rules in CTI would have not taxed it anymore because I tax foreign earnings of foreign subsidiaries less heavily than I do in the US. Right? So I would maybe have avoided the 6% incremental US tax. Okay, and importantly, the US anti-deferral regimes are not applicable here. Right? Because there is no deferral. I have to be in corporate form in the foreign jurisdiction for first there to be deferral, and then I have my anti-deferral regimes of subpart F, Guild B, and CPI. Okay? Okay, so I added a bunch of colors. This is summarizing all of the cases, and what I want you to focus on is, what I showed is, I put in green what I consider worldwide ETRs at 21% or below. Okay, not what I consider, what the facts actually show in these examples. And to me, if I'm a US multinational and my CFO is on an earnings call, he is not going to have to justify why his effective tax rate, his or her effective tax rate is 21 or below. Because the analyst community should be thinking, oh, it's a US company, I would expect you to pay 21%. You pay less than that, great, you're doing really good, but paying 21, I'm not going to be that concerned about it. If you're drifting above 21, a little bit higher, I put in yellow. So case 3, which case 3 was a low tax jurisdiction, but I paid a dividend and I had a 30% withholding tax on it, so that caused me to go up from 21 to 27.75. Right? I'm going to have to explain that. What would I explain? Well, I repatriate from a jurisdiction that they don't have a tax treaty in, we're in that country because of non-tax reasons, but I get hit with a higher withholding tax, and so that boosts my effective tax rate. And if I do the case 7 here, I have still a high tax foreign jurisdiction, but I pay interest in royalties, and that pulls me down from 30% to 25.5. If you go back and look at that example, it's because I'm blending between the 30% because I moved $5 million of income and had a tax at the U.S. rate of 21%, so that pulls down that 30%. Okay, so if you look at the lowest possible here, case 1. Remember what case 1 was. Low tax foreign jurisdiction relative to the U.S. So it's below 21, but it's above the 14 for the NCTI regime to apply. So I don't have any residual U.S. tax on that. And I have a 0 repatriation policy, meaning I'm reinvesting my earnings. That keeps my effective tax rate at that foreign number, 15%. Now, that could be really good, and if I'm hyper-focused and hypersensitive to my worldwide effective tax rate, but it doesn't give me any cash in the U.S. So factually, I have to find something to do with that cash, right? Because if I leave cash on the balance sheet and it's sitting in a bank account earning, 2 or 3%, that's not going to get me very, very much on my return on assets, right? So ETR versus maximizing the cash. If my facts line up and I'm really reinvesting this cash in that foreign jurisdiction to grow that business, it's a great fact pattern. Compare that to alternative 6. High tax jurisdiction, I'm taking out half of my earnings as a dividend, subject to a 30% foreign withholding tax rate because I don't have a treaty. Wow, that's really ugly. Over 40%. I'd have to answer that question on the analyst call. It's like, well, you're 21. Why are you doing it with 40% effective tax rate? These are the facts. I have a 30% jurisdiction. I'm there because of this, and I repatriate from there, and I don't have a tax treaty. So that's the problem. So I think when you're going back and look at these, try to roll through all 9 of them and just compare and contrast them. Like, what are I like to think of it again as levers. The levers can be good, but the levers can be bad if the business is pulling the levers that are causing the taxes to be higher. Okay, so lots of stuff in Chapter 8. We talked about the evolution of conducting a foreign business, both from the least amount of touches to the foreign jurisdiction from the United States, remember export sales, licensing into the country, those types of things, all the way to the full-born, I'm setting up a foreign corporate subsidiary, I'm doing business there, and I'm going to be there for a number of years, right? And then closely following that is, at what point do those activities make me become subject to income tax in that foreign jurisdiction? Right? Not a bad thing, but I just need to know at what point do I have to start being compliant and filing taxes and things locally. We talked about, again, the alternatives for accessing the foreign markets and both looking at those from a U.S. tax perspective and a foreign tax perspective. I think that'll start pulling together all of the concepts we both talked about in half A and here in half B. Then we talked about outbound planning. I went through like a series of tools, if you want to stick with analogies, tools in the toolbox that the outbound tax consultant brings to the table. These are things to help a U.S. multinational get to one of these lower effective tax rates, right? And then the financial reporting implications, and they also layer into this because this is effective tax rates, right? Effective tax rate is your book tax expense over your book pre-tax income. So if you get to book a deferred tax benefit, that's going to help you. The deferred tax benefit is lowering that denominator, which is going to lower your effective tax rate. So don't just be focused on the cash tax numbers, which are largely these numbers. You also have to look at what happens from a book tax perspective. And then we did the comprehensive exam. Okay, so now we're going to shift to chapter 12. Okay, so we've touched upon this several times throughout half A and half B, transfer pricing and what it means. Now we're going to go down another level into what transfer pricing means. Transfer pricing is a profession, within accounting. There are transfer pricing partners, always have been in accounting firms, always will be. If you're looking for roles and positions that have staying ability, if you will, sustainability, that are always going to be in demand in the marketplace, transfer pricing is one of them. The things we're going to talk about, I have not run into one country who thinks they have enough revenue coming into the government. Politicians always think they need more revenue. And it's easier to chase corporations for revenue because one, corporations do not vote, individuals vote. So if you're chasing individuals and you raise their tax rates, that's one sure way to get voted out of office. So they chase these, distant, amorphous corporations that are out there, right? Big bad corporations aren't paying enough. And transfer pricing, you're dealing with cross-border, so stuff from one country to another country. The jurisdiction that is bearing the expense is usually always thinking that they got the short end, that they didn't get, the expense was too high, right? The company's charging too much because it's a related party transaction. There's an incentive to overcharge their particular jurisdiction. We'll talk in a moment. Sometimes you'll see the income jurisdiction on the cross-border transaction thinks they didn't get enough income. The U.S. tends to think that for their U.S. multinationals, that you're moving too much income away from the United States. So transfer pricing is the discipline that sits in the middle of that and tries to justify the intercompany charges, the pricing of intercompany transactions. And I just feel like that is something that is never going to go away because you have competing jurisdictions around the world. There's not a world's tax police, and there's always going to be disputes, and companies are in the middle, and they're trying to invest globally and do their business around the world, and so they're always trying to justify these things. So you have two elements. You have the current pricing and trying to make sure that's as accurate as possible so I don't get into a dispute. But inevitably, I will get into disputes, and then I have this dispute mitigation, right? This whole exercise, and big accounting firms and big law firms have dispute resolution practitioners as well, which step in, okay, there's a big argument, I'm going to be on this case for years while we're arguing about this and going through the various levels of appeal in a jurisdiction to try to get resolution on these things. And as you'll see in the Microsoft case that we talked about a little bit, the numbers can be astounding how big they are. So that also focuses the attention of everybody involved. It's like, okay, this is going to take a while because this is not something we can just cover overnight. So I'm going to try to demystify what transfer pricing is. Then I'm going to pull you through transfer pricing methods a little bit. I'm not going to go through every one of them because it can get a little tedious. So I just want to introduce to you of those so you kind of see the methodology of what people do in the transfer pricing world. Then we're going to talk about documentation. This is one of the areas you saw in the Microsoft articles I assigned. Documentation is key. It's the company telling their story, right? And the portions of those articles where it said the government, the U.S. government historically had difficulty in this area, winning cases, because the taxpayer is always in the best position, right? They have the facts. They have all of the facts. The government has limited facts because they're looking at your tax return that you filed, right? They don't know all the nuances of Microsoft. So they're inherently, I like to think of it, they got one hand behind their back. But you have to take that seriously and put forth your best case possible because if you can avoid a dispute, way better off, right? Way better off than getting embroiled in a dispute and then trying to extract yourself out. There's information reporting requirements. We're going to talk about how you have to report all this stuff, and then adjustment penalties. The penalties here are pretty drastic. The government's using that as kind of a stick to make companies take this seriously and do their best effort from day one. Do your analysis, document it, get to an arm's length price. If you're materially off, I will hit you with a big penalty. Not only will I adjust your pricing to get it to arm's length, but I will hit you with a penalty on top of that as a deterrent for anyone not taking this seriously. And then we're going to talk about developing a transfer pricing strategy. How do you approach this, knowing this is a difficult area? How do you handle this from the get-go? Okay, so let's take the Microsoft case. So this is an ongoing IRS disagreement with Microsoft, and the years at issue are 2004 to 2013, so a 9-year period. So one of the other things that's very interesting about transfer pricing is if one of the government authorities involved, either the US or the foreign jurisdiction on the other side of the transaction, once they seize upon an issue, it's not an isolated issue. Because usually the pricing has happened for a number of years. So if the US doesn't like it in 1 year, what they say is, oh, let me see all your other years. Oh, I see you did the same thing in all those years. Let's put them all together. I want to win every one of those years. So this is why the number got so big. And it's 28.9 with a V. Right? That pays a lot of fees. I don't know how, they probably got 2 or 3 law firms on this. The government, shockingly, hired a law firm to represent the government. Right? Because the government has deep pockets, but we don't have a stable of just litigation attorneys out there, right? They do have them, but the government doesn't invest as much as other countries do in their enforcement vehicle. So in this instance, kind of a rare instance, but I think given the magnitude of dollars at stake, actually went out with a third party to represent the interests of the U.S. government. So again, you're going to have extremely qualified people on both sides, right? Microsoft might have almost as deep pockets as the U.S. government. They just don't have the printing press like the U.S. government. So the U.S. government can go on for a long, long time, but Microsoft can as well. So this involves a cost-sharing arrangement. I'm going to explain to you at a high level what a cost-sharing arrangement is, but it's very common in the high-tech industry, very common in the pharma industry, just given the amount of intellectual property that is involved in those enterprises. And again, these things can last many years. So the simplified cost sharing arrangement. So we have Microsoft US, and they did these transactions with subsidiaries of the US company, 100% owned subsidiaries. So we are completely related parties, right? You have to have a transfer pricing dispute does not happen amongst unrelated parties, right? If Microsoft was dealing with Oracle, Puerto Rico, this transaction doesn't come to bear because the government knows that they have the advantage of third parties negotiate, at arm's length automatically. One party doesn't want to pay more, one party doesn't want to charge less, right? So they get to the right number. So we have 100% ownership. I just show Puerto Rico here. You saw in the article the other 2 jurisdictions is Ireland and Singapore. The reason those 3 jurisdictions are there is Puerto Rico purportedly owns the North American and South American rights to the software for Microsoft. Ireland owns the EMEA rights for the same software for that's Europe, Middle East, and Africa. And then you can imagine Singapore owns the Asia Pacific rights for that. So what they did originally, and I never worked on Microsoft, so I'm just going off the public record. They bifurcated the world between North and South America, probably Western Hemisphere, and then EMEA, and then Asia Pacific. And they said, okay, we want to manage our intellectual property centrally, but what I also want to do is I want to do that tax efficient. So they picked a country in each one of those jurisdictions that was low taxed. Puerto Rico, I put here, gave Microsoft a 15-year tax holiday. A tax holiday is an incentive from a local country that says, hey, if you invest in our jurisdiction, I will charge you a lower tax rate that I would otherwise be entitled to do. So Puerto Rico was very interested in having the name of Microsoft and the cachet and the investment in the country. So agreed to it's not clear, it was a 0 to 2% over that 15-year period. It probably changed over time. Ireland's 12.5%. That's kind of the lowest you're going to get in Western Europe. You can't get real low. Singapore real low as well. Because Singapore is just a country that really likes to compete for types of regional headquarters. Okay, so a cost sharing arrangement. What a cost sharing arrangement is we want the parties to a cost sharing arrangement in a related party setting to be able to exploit the IP that results from the intellectual property that they incur the cost to develop. Okay, so for North America and South America, Puerto Rico, Microsoft Puerto Rico said, we are going to incur the cost to maintain and develop that intellectual property. And think about Microsoft Office. That's what we're talking about here. Excel and Word and all that stuff, PowerPoint. And Ireland agreed to bear the cost for the EMEA region. Singapore agreed to bear the cost for the Asia-Pac region. Now, that works great for brand new intellectual property, right? We're going to start a new piece of software, and they're going to start incurring and bearing the cost for doing it. But inevitably, these arrangements don't start with brand new IP. Typically, they involve existing intellectual property. So what happened in 2004, this is the dispute with the IRS, is Microsoft already had Microsoft Office software, right, that already existed. So each one of these jurisdictions had to do what is called a buy-in payment. They had to purchase from Microsoft US those existing rights to those regions. Big number, right? But after that, I like to think of buy-in payments. That's to get in the door, right? Puerto Rico doesn't have anything. They have to buy the portion of the intellectual property to become the owner of it. And from that day forward, they fund all the costs to maintain and develop the intellectual property. They do that in exchange for the return on that intellectual property. Okay? If you think about Microsoft US, in these years, this is pre-Trump, right? This is Obama and before Obama, George Bush, I guess. Those jurisdictions, those administrations before, and we were 35%. The United States was 35% corporate tax rate. So I've taken a 35% corporate tax rate, moved it to 0 or 2% in Puerto Rico. Or EMEA, I moved it from 35% to 12.5%. In Singapore, that I don't know, but I would suspect something around 5 or less. And so significant tax savings. Okay. The IRS came in, looked at the relative returns and said, you have to be kidding me. Puerto Rico is getting 47% of the global profits from Microsoft. Microsoft is a US company. They developed all of this in Redmond, Washington. So how is that possible? So they took a dispute on the buy-in payment. They said that because the buy-in payment's a taxable event, right? If you're Microsoft US and you transfer existing intellectual property and you get cash, that's taxable, right? There's nothing against that. But the IRS said it wasn't enough. You needed to pay a higher tax because there is no way that you would have sold that intellectual property for North America and South America or EMEA or Asia-Pac to a third party for the price you did to a related party. The only reason you did that is because it's a related party and you want to pull down your global tax rate. So Microsoft is arguing, no, we're following your rules, your regulations on cost sharing arrangements, and we followed them to the T. That's their argument. Right? The government is saying, no, you didn't. You priced it incorrectly because it's not what an arm's length person would have charged for this. And the whole reason you did this was because you were trying to lower your U.S. tax liability. Have a debate here about the rules and how they're applying and are they applied correctly, the regulations. but also this overarching view where the government can argue, you only did this for tax planning purposes. Okay? It's kind of it's a business purpose element that the government can always argue, because the case law that's out there, the court cases in the past have always said that a taxpayer has to have a business purpose for their transaction other than tax savings. Okay? Once you have a business purpose, then you can structure your transaction tax efficiently, but tax can't lead the business. We saw that in the articles. Right? That was a key takeaway. I'm sure there's some pretty bad email traffic because the government got the ability to discover the documents that they wanted to look at. Inevitably, in a large organization, people write things down that they don't want to be seen by anybody, but nothing goes away, as you guys know. So emails get discovered, and if people are talking about, oh my gosh, look at this, we're going to take our 35% income stream out of North America and drop it into Puerto Rico at 2%. Right? Huge tax savings. So importantly here, this ties back to what we talked about in class in half A and half B. What was the U.S. international tax regime during this period? We had subpart F, right? So we have a corporation. Puerto Rico, Ireland, and Singapore were foreign corporations of Microsoft. So we started off with deferral. The only anti-deferral that we had was subpart F. Remember subpart F, certain income streams and related party transactions crossing two borders. So let's test this on, so the subsequent transaction was Puerto Rico selling to the United States. So Puerto Rico manufactured the software and sold it to the United States, who then sold it to third parties. So did the transaction cross two borders? No. It went from Puerto Rico to the United States, and then the United States sold into North America. It's not subpart F income. And it's also not subpart F income because Puerto Rico manufactured the product. They had a facility in Puerto Rico where they made this. And that's the same analysis for Ireland and Singapore. So the only rule that would frustrate what Microsoft was trying to do was subpart F from an anti-deferral. We did not have guilty. Guilty came online in 2017, effective 2018, first Trump administration. We didn't have NCTI, which starts this year. Okay, so if those regimes were in place, think about what guilty does. It focuses on global, intangible, low-taxed income. That would have been Puerto Rico. So that would have pulled Puerto Rico's tax rate up. The NCTI regime pulls it up to 14%. So prospectively, the spread of savings that you can save from tax rates is much less. The Republicans have tightened that up. Why? What are the policies of this administration? They want this stuff done in the United States. Can you imagine talking to President Trump and asking him whether he wants this done in Puerto Rico or Seattle, Washington? I think we can all agree what he's going to say there. So those regimes are trying to lower the tax benefit, which then makes this less appealing, less attractive for planning. Okay, so this is still going on. I think they're through the appeals process or close to it within the IRS. So when you have a dispute, you saw the notice of proposed adjustment. That's the $28.9 million. That's when the government does their analysis with their advisors, the law firm that's helping them, and did their calculation, said, you owe us $28.9 billion more of tax from the years 2004 to 2013. That's called a NOPA. The Notice of Proposed Adjustment is the form that is delivered. And that's kind of the shot across the bow. The government has formally proposed an adjustment to the tax return. And so what Microsoft has done, and they're allowed to, any taxpayer is allowed to, you can appeal within the IRS. So you go up to the appeals. That's a group of people that are very experienced in tax disputes that try to be dispassionate about the facts and look at it analytically. Because what can happen is the company can get very excited, and the auditors for the government can get very excited or very invested in the argument. And so the government has layers where you can appeal up, and you get somebody who is not involved on the day-to-day facts, who's supposed to look at it and say, okay, who's got the best argument here? Okay? So Microsoft is almost through that. They haven't been able to get the number knocked down. The next step after that is you go to court. Okay? And the reason I think this is going to be around for a little while, again, you have deep pockets on big numbers. You have deep pockets because you need to be able to fund this dispute because it's costing you money, right? You probably don't even want to know how much Microsoft has spent on professional fees on this transaction. The government's doing the same, right? The government has unlimited budget. Microsoft's close to unlimited budget. So you have a very interesting dynamic how this is going to go. And so I think the article was saying like the late 2020s. So in the next 3 or 4 years, we should get resolution of this at some point in the court system. But remember back when you're out working, when you see the resolution of this, it may not go to the Supreme Court because the Supreme Court, right, they don't have to review every appeal to them. They get to choose the cases that they want to look at. For some reason, the Supreme Court just does not want to do taxes. All right, you had plenty of time to deal with this in our system, and you can't come to us. We have bigger things going on. So you'll get to some higher level, but it'll be very interesting to see how far this goes. Yes?
Is that 28.9 billion like mostly from it not being an arm's length price? Because that seems like the only thing they did wrong.
Yeah, it's all interconnected because if you didn't pay enough up front, right, you didn't have a big enough gain that was taxed in the U.S., so that's a big chunk of this. But then it's the resulting income is attracted because all of the earnings for North America, a big chunk of them are earned in Puerto Rico because they're the owner of the IP. If you said whatever you paid, you didn't pay enough, and then so the income you captured in Puerto Rico in the supply chain, if you will, the pricing was wrong because they weren't entitled to the full pricing. So it's probably a blend between the buy-in payment and the profit split between the entities. But yeah, it'd be really interesting to see that calculation. And that's where the government's at an inherent disadvantage, right? But they can, that's why I call it a shot across the bow, because they may not have perfect facts, but they can say, okay, these are the facts I have, this is the number I think, I'm going to propose the adjustment. You can fight it. So that's where they are at this point, is arguing about that particular number and the facts at hand. So that's, in a nutshell, what transfer pricing is. You'll see there was a slight mention in one of the articles Coca-Cola had an issue. They had a similar issue. So what the beverage companies were doing, and I've had this explained to me, and it still doesn't make sense in my brain, but there's like flavor packs, like concentration of Coke and Pepsi. And so that is what is the value, is that small little flavor pack, and that's what makes the soda. And so Coca-Cola, I know Coca-Cola did it because that was the case as well, but they tried to do this as well, which is disseminate the non-US rights to other parts of the world for Coca-Cola, because it's been a global company forever. The government takes issue with that buy-in payment as well. It's like, oh my God, Coca-Cola? Everybody in the world knows what Coca-Cola is. And the value that you transferred it to your foreign subsidiary, a related party, is not near the value that you would do if you sold it to a third party. Okay? They took issue with that as well, and that was like $3 billion, which pales in comparison to this, but still $3 billion on its own, massive. Interestingly enough, Apple did something like this way back when. So again, these are not inside facts. These are just all public facts that are out. So what Apple did, if you know anything about the history of Apple, it wasn't always the behemoth that it was now. So they went through a period where they did the first computers and desktop computers. And so the Apple IIe, the Apple Mac, those things started and they went through a really high growth phase. And then they kind of took a big dip as personal computers got commoditized and it was a race to the bottom in pricing. So they went down for a period of time and then they reinvented themselves with the iPhone, right? And now they're one of the most valuable companies in the world. During that trough period when their valuation, market valuation was really low, they transferred out some intellectual property from the United States to Ireland. And they did that based on the value of the intellectual property at that point in time and extrapolated it to their market cap, right? Like, my IP can't be that valuable if the public is valuing the whole business at this. And so they took advantage of a low market point, transfer some intellectual property that became a global blockbuster, iPhone and everything that came from it. And so much of that is owned outside the United States. So if you go, I've mentioned a couple times, if you go to Dublin, if you go in the commercial district, you'll see Apple is very prevalent down there. That's because of this transaction. And so Apple was able to support their pricing because their market cap was way down. Contrast that to a Microsoft or a Coca-Cola where the market caps have always typically been very high. It's very difficult to argue that you transferred kind of the crown jewels of the business and pricing you did it wasn't, unreasonable. So just companies do this, they move IP, but the United States is laser focused on this. And why are they laser focused on this? Because this is the country where they created the intellectual property, it gave them the environment to develop that and exploit it. And they don't want to see, okay, now you got the asset, now you want to transfer it out to the United States at an arbitrarily low rate. Yes, but
And I'm guessing that's where guilty is applied.
yes, yes. So great question.
Circumventing their clever move
So-
before.
Guilty, yes, guilty for this, because this is very time consuming, right? To go around and argue about this and everything. So guilty, they don't have to argue about the transaction because I'm going to tax the income anyway. In CTI, I'm going to tax it anyway. Not all the way up to 21. In CTI is going to cap it at 14%, but I'm still, the super low tax jurisdictions aren't going to get any revenue because the US is going to tax it up to 14%. The way to kind of start pulling this all together is, again, think about what the Republicans were doing when they changed the international tax regime. Guilty is the stick, people like to call it that, because, remember, it's the acronym guilty is you did something. Like, I may not have caught you when you took the intellectual property out, but you're getting these outsized gains in foreign jurisdictions above the 10% return on your tangible assets. They're kind of assuming that you did something inappropriate at some point in the future. Right? Now remember the FDII regime, the export benefit regime, that's the carrot. So the US has a twofold way of dealing with this problem is, one, I will tax you if you got through the system and I didn't tax you when you took it offshore to begin with, and I will then tax the earnings now, currently. But I also want to dangle a carrot, meaning don't even do this. Because I will tax your income at 14% if you do all this in the United States. Isn't that easier than trying to do this in Puerto Rico and moving product back to the United States? You can do all this in the state of Washington down the street from your headquarters and control everything. Right? So that's the architecture of the regime now. Great question about how the two-pronged approach to deal with this problem instead of this very time-consuming effort. Now, they have to do this for these prior years because the regimes weren't in existence, right? And these are long-standing cases so that people are just dug in and they're going to continue to fight on these things. Volume of dollars at stake here. Great question. Okay. So, what is transfer pricing? Besides the cost-sharing arrangement, I just want to kind of give you the big grand scheme of what's going on a brand name. So, various operating divisions of a multinational corporation usually engage in a variety of intercompany transactions. A company may sell manufactured products abroad through its foreign affiliates, or vice versa, right? So the US could manufacture and want to sell into foreign countries. That has to be priced if you're selling it to a related party before it goes to a customer. It could be I manufacture offshore. I want to sell into the United States, so I sell it back to the United States, who then sells it. That has to be priced, right? You could have intercompany services. You could have management fees, technical fees, and IT fees. You could have administrative fees, shared legal services, back office services that are being done to its foreign affiliates or vice versa. All has to be priced. The company may license its intangibles to foreign affiliates or vice versa. Whoever's the owner of the intellectual property may allow other parties access to it. So you could just see the magnitude of things that grow over time, because a global organization will always try to be more efficient. And being more efficient is not to have 10 IT departments around the world. I might have one IT department. I might have one on each hemisphere, one in every major location or major region. But other countries are going to benefit from that, and I have to price those services around for those activities. So the U.S. company and its foreign affiliates must determine an arm's length transfer price. So when people say arm's length, just so you know the analogy, I'm dealing with someone other than in a friendly manner, right? An arm's length. So when two parties that are unrelated negotiate, if I'm selling, my used car to you, you and I are going to negotiate the price. You're going to be inherently wanting to pay less, and I'm going to want to pay more. That's an arm's length negotiation, right? And the standard that you're held to, the standard of arm's length, means a buyer and a seller, or it can be a service provider and a service user. But the buyer and seller negotiate at arm's length with each knowing the full facts. That's the standard you're held to. It's the standard of me selling my used car to you. You know what the car is, you look at it, you're going to test drive it, you're going to come up with your price, I'm going to have my price, we're going to negotiate that down. That's the standard we're held to. Even because the government knows that that kind of rigor doesn't naturally happen amongst related parties. If I'm selling my used car to my daughter, I'm going to give her a good price. So the government understands that, but the standard we held to is not the way a father treats a daughter, it's the way a father treats someone down the street. Okay. Establishing transfer pricing ensures the proper allocation of profits across tax jurisdictions, right? If I don't have the proper pricing, I'm skewing profits one way or the other, depending on how I skew it. And another reason why transfer pricing is not going away, the same issue happens in the United States. So we have 50 states, right? So very few companies do business in only one state. Companies around here in St. Louis are certainly doing business, many of them are certainly doing business in Illinois, because it's right across the river, right? Close proximity. So two states are just like two countries. If I have my Illinois subsidiary doing business in Illinois, and I have a St. Louis parent company, and they're doing transactions amongst those, my two parties that are interested in that as well is the state of Missouri and the state of Illinois. Just like a country, if my pricing is askew, the taxable income is askew. So if you really want to think about like the longevity of transfer pricing, not only do you have it globally, you have it in the states in spades, because your big companies in the United States are doing business in at least 48 of the states, maybe even Africa or Alaska and Hawaii, but coast to coast in the continental U.S. And you have disputes amongst the states all the time. Okay? Because you see that in the press as well. There's not one state that's getting the full amount of revenue that they need for their state, right? Everybody's short on cash, so you have this constant tension on the state side as well. Okay, let's do 12.1. Eli.
USACO, a U.S. corporation, manufactures engines for sale both in the United States and abroad. Forco, a wholly owned foreign corporation, conducts foreign sales. On a per unit basis, USACO's engines cost $600 to manufacture and sell abroad for $1,000. Regardless of the transfer price used for sales by USACO and Forco, combined gross profit from the foreign sales $400 per engine, final sales price minus $600 manufacturing cost. However, transfer prices do affect the allocation of that combined profit between USACO and Forco.
So let's just say this ownership is 100%. So we've talked about how we tax people need to see things on a legal entity basis because we're dealing with jurisdictions. This is why accounting people and business people will not be too helpful in helping you analyze this transaction. Because what are the financial statements? The financial statements is this. It's the $600 of cost to build the machinery, and it went out of the group at a $1,000 sales price. Accounting is going to see $400 of profit. Because whatever you do between the two entities, they're going to eliminate. Right? Legal, not necessarily going to care about the intercompany price. Tax people care about the intercompany price. You have to be compliant with the law in the United States and the Forco jurisdiction. The only way you can do that is to make sure you have an arm's length price for the sale from the U.S. to Forco before it goes to the customer. So that's the question: is what price do I put on that sale? Okay? That's going to be the critical piece for this. And so at one extreme, the transfer price could be $600. So U.S. sells to Forco at $600, which is basically its cost. So what does that do? Obviously, that puts the $400 of gross profit in Forco's jurisdiction because they paid $600 to the U.S., so their cost of goods, their inventory is going to be $600. They sell it for $1,000. You're going to capture all of the profit in the Forco jurisdiction, right? I think we can all agree that extreme is not viable, right? Nobody sells the product that they manufacture for its cost, right? That's a surefire way to not be profitable, right? Use the cost to manufacture, okay? If you do that at the other extreme and capture all the profit in the United States, so the U.S. manufactures it for $600 and sells it to Forco for $1,000, Forco then sells it to customer for $1,000, you've moved all the $400 into the U.S. and taxed in the U.S. Who's going to complain about that transaction? Not the U.S. jurisdiction, because they got all $400. If you want to do that, that's fine. I'll tax you at 21% of the $400 profit. The foreign jurisdiction is going to have a problem with this. Because they're going to say, who buys something only to sell it for the same price? That's just doing work for no compensation, right? So obviously, the transfer pricing would result in some sharing of the profit between the U.S. and Forco's jurisdiction. Okay? How is that going to be done? That's going to be based on the risk and responsibilities of the U.S. and the Forco in the overall flow of the goods and the customer relations, and what is the most valuable to the supply chain. Okay, so somewhere in between there, but that's setting up what the problem is. It's easy to say, well, you need to allocate some profit to both, but what? How much? Okay. And so when tax rates vary by taxing jurisdiction, which can be in the case of foreign countries or U.S. states, right? My example of Missouri and Illinois, Illinois is a higher tax jurisdiction than Missouri. You guys have been following the news. There's also a proposal in Missouri to do away with the income tax. Quibble on whether that's the right policy analysis or not, but that could greatly influence one's transfer pricing between transactions between a Missouri parent company and an Illinois subsidiary corporation of that parent company, right? Because I'd want to mitigate my tax liability in Illinois, increase my taxable income in Missouri, because perhaps I can get a 0% tax rate if the Republicans get what they want to do. So, it's not just foreign countries, it's foreign states, because states have different tax rates as well, as countries do. So, 12.2 is, Genevieve's not here. Anybody want to do 12.2?
Tax rates vary by taxing jurisdiction. Foreign countries, that is foreign countries or US states, selecting a transfer price can significantly impact the taxpayer's total tax cost. So in example 12.2, the facts are the same as in the previous example. So assume that the US tax rate is 21%, the applicable tax rate is 25%, and the operating expenses are negligible. Given the rate differential, the USA Co. Group can reduce its worldwide taxes by using higher transfer prices for its outbound controlled sales.
Let me pause you there. So when they say controlled, they mean that's the related party transaction, because since you have a parent company owning a subsidiary corporation, it's a controlled transaction, right? Because no one can complain about it. An uncontrolled transaction is my example of me selling my used car to you. I can't just arbitrarily set a price because you say, okay, I'm not buying it. Right? Here, Forco has to buy it. They're a subsidiary of the parent company, so that makes it the controlled corporation, or the controlled sale.
USA Co. charges a transfer price of $1,000 for the sale. The $400 gross profit is allocated entirely to USA Co. and the total tax decreases to $84. That is 400 of income times 21% tax.
Because you're looking at, it would otherwise fall to a 25% jurisdiction, because Forco's 25% and the US is only 21.
However, at the other extreme, if USA Co. charges a transfer price of $600 for a sale to Forco, the $400 gross profit is allocated entirely to Forco, and the total tax increases to the foreign tax of $100. That is 400 of income times 25% foreign tax.
So, what this is trying to illustrate is the tax rates at issue between the two jurisdictions. These could be states, this could be Missouri and Illinois subsidiary, this could be USA Co. and Forco. But by peaking towards the rates, you can try to influence your tax rate, global tax rate. But transfer pricing is going to step in and make sure that that pricing has to be arm's length. And I have seen in the past where you might be on the right side of the exchange or the tax rates and pushing income to the lower tax jurisdiction, but we know tax rates don't stay the same, right? One country can raise their tax rates in the future, then you're, oh, now I'm offsides on that. So you can't just pull the levers and move the income around absent the transfer pricing regime to try to get to the lowest tax burden. Okay, thank you. Okay, 12.3 is Xinyi.
Tax rate is lower. US will charge a higher price for ships based in the US, but the tax rate is higher. So transfer pricing as where profit is reported and how much total tax that will face.
Yeah, so now we're dealing with a 21% jurisdiction and our foreign subsidiary is 20. So the spread is not material in my mind, so trying to waste time thinking about moving profit one way or the other is not going to be that big of a benefit. It's not like the Microsoft example of 35% and a 2%, right? Where moving profit is a big deal, but still, this is just an indication that the pricing for the intercompany transaction is going to influence which country gets to collect the income. So, although from a global basis, you might not get a lot of benefit for pushing it one way or the other, the countries certainly care. Because every dollar you don't pay in tax to Forco, Forco's interested in that, right? And Same thing for the US. Okay? Now, the US anti-deferral regimes warrant consideration in migrating profits to US-owned foreign subsidiaries, right? So, you can't just look at this from, okay, if I have, we've talked about transfer pricing being a range, so it's usually not a point, hard number. So usually it's between, so it might say here, we're gonna trade through the transfer pricing at 700 to 725, something like that, pulling numbers out of the air. So within the 700, 725 range, you could pick any number within there, so you can move the dial a little bit by choosing which one's most advantageous to you, but you have to look at this in totality. What is the US gonna say about any profits you put in Foreco? You got subpart F to think about. Is it a transaction flow, type of income that the US is going to pick up under subpart F? If not, is it caught under the GILTI regime, caught under the NCTI regime post 25? Okay? All of that's going to impact your global tax rate. Okay? So that's outbound investment, pushing income out of there. The inbound investment, transfer prices also affect not only the amount of income reported in the US, but can serve as a repatriation mechanism to move cash from the US abroad, avoiding US withholding tax that may otherwise be incurred on dividends, right? Because if I have transaction flows, I can move income and I can move cash with that. So it might be a mechanism where I can get cash out of a jurisdiction to another jurisdiction other than as a dividend, because if I don't have deductible payment, then I'm left with dividends. And is that kind of withholding tax problem or not? 12.4, Pace.
Okay, so in this example, HKCO is a trading corporation organized in Hong Kong, and their corporate tax treaty with the their corporate tax rate is 16.5%, and they don't have a treaty. And then HKCO.
Yeah, so it's interesting. Those of you that do not know, the United States treats Hong Kong different than it does China. So the United States does have a tax treaty with China, but Hong Kong is not, for purposes of the treaty, not considered to be a party to that tax treaty. So you have to be careful if you have inbound investment into the United States with Hong Kong above the United States, because any repatriation of dividends is going to get hit with a 30% hold.
And then HKCO has a U.S. subsidiary called U.S. DIST, which purchases widgets from HKCO for resale in the United States. And then in addition to the 21% normal corporate level U.S. tax, there's also a 30% withholding U.S. tax rate on any dividends paid to HKCO.
Because there's no treaty, so right, we're left with domestic U.S. tax law, and that says 30% on FDAP.
So the total effective U.S. tax rate on the repatriated earnings to HKCO would be 44.7%, which would be first at 21%, and then the after-tax amount of 30% times the 1 minus the original 21%.
That's assuming I repatriate all of my earnings, all of my after-tax earnings from the United States back to Hong Kong as a dividend.
Which gives you like 79 and multiply by 30. So that adds to 44.7%. And so as a result of this, to the extent that HKCO can reasonably justify charging a higher transfer price on its widget sales to the U.S. distribution subsidiary, every dollar of income shifted from the U.S. subsidiary to the parent company HKCO, the first one being the 44.7 tax rate, the second one being the 16.5 tax rate, can result in tax savings of just over 28 cents on the dollar.
Yeah, so I'm moving income out of the United States via deduction, effectively, because I'm paying for the product. That product would be my inventory, but it becomes a deduction when I sell the inventory, right? It's a cost of goods sold transaction. So this is a way that I avoid a problem in the future, which is I can't pay dividends out and then get my effective tax rate up to 40, almost 45%. I can keep it much lower if I could arbitrarily limit the tax basis left behind in the U.S. by having to pay more to Hong Kong for tangible goods. So this big issue when the US was 35%. Pre-Trump 1.0, when we were 35% corporate tax rate, we were high relative to the rest of the world. So all inbound investors were very keen on trying to lower their US tax liability. They did that. They couldn't lower the rate, but they could lower the base. How do you lower the base? Try to get deductions out of the United States, either charge management fees, charge royalties, lend into the United States, or here via tangible flows, charge more for the product. Okay, even in cases where the U.S. corporate tax rate is lower than the foreign parent company's rate, avoiding U.S. withholding tax on an otherwise inbound dividend to repatriate cash can make transfer pricing an attractive alternative. 12.5, Genevieve again. Missing out on lots of. Anybody want 12.5?
Did it, yeah. Read off the thing. Even in
If you
cases,
can see that.
yeah,
You can do
even in cases where the U.S. corporate income tax rate is lower than the foreign parent company's tax rate, avoiding U.S. withholding tax on an otherwise U.S. dividend, create cash can make transfer pricing an attractive alternative. And then Talco is an Italian corporation with a U.S. subsidiary. Talco sells gadgets to U.S. sub for distribution to customers in the U.S. Tax rate in Italy is 24%. United States, obviously, we know is 21%. And the withholding tax on the dividend under the Italian-U.S. tax treaty is 5%. Therefore, the total effective U.S. tax rate on U.S. subs earnings repatriated as a dividend is approximately 25%. And as we're taking that 21%, adding that 5 times 1 minus the effective tax rate, and then, statutory tax rate. As a result, to the extent a Talco can justify a higher transfer price on its gadget sales to U.S. sub, every dollar of income shifted from U.S. sub to a Talco results in tax savings of 1%.
Yeah, so it's instead of letting the profits fall to the U.S. sub and then repatriating them as a dividend and attracting that 5% withholding tax, avoid the 5% because the purchase of product is not subject to withholding tax. Right? A transaction flow where you're buying product is never going to be subject to withholding tax, so you can just cap this at 24% Italian rate. Thank you. And so this is again an example of inbound planning where if I was involved in this transaction, I'd be working with my team in Italy, and they would be advising the Italian parent on the transaction, but they have to get U.S. advice on this because the U.S. is the jurisdiction that would be incurring the higher transfer price, right? So they would need transfer pricing advice to make sure that they can support that higher price. Okay, example 12.6. So this is just showing you the large number of related party transactions. 12.6 is Eli.
Canco manufactures widgets in Canada for sale in the United States. Due to increased widget orders from U.S. customers, Canco decides to form a U.S. distribution subsidiary, U.S. sub, to buy and resell widgets. Although U.S. sub does not have any manufacturing functions, U.S. sub employs its own administrative and sales staff while using Canco's proprietary distribution software. In an effort to ensure that U.S. sub is financially solvent, U.S. sub has payment terms on its trade receivables to Canco of 6 months, which is U.S. sub's average collection period is 1 month. If U.S. sub's customers do not pay, U.S. sub enjoys the use of Canco's collection staff. Finally, U.S. sub uses Canco storage.
Yeah, so I look at everything on the left side. You see all the value provided by the Canadian parent to the U.S. sub. Loan, storage racks, collection staff, software, and widgets. And then on the right are all the compensation payments from the U.S. sub to Canco for those services and products. And so it just shows you the volume of things that can be created over time. And these things can be immense. Again, this is one jurisdiction, right? If you're advising this Canadian parent and they're in 50 countries, you got this stuff in spades all over the place. And each country involved is looking after their own best interests. And so providing that documentation and looking at this holistically by country can be an enormous undertaking to try to be compliant around the globe. So, and again, these things kind of mushroom as the business grows and you have the length of time where there's intercompany transactions. These things can be very, very crazy. Okay, I'm going to stop there. We'll pick up with the transfer pricing methods on Monday next week. We're going to finish with transfer pricing, and we're going to do cash treaties, and then we're going to do pillars 1 and pillar 2 of the OECD. We only have 2 more weeks. Okay, I'll send you a note tomorrow with all that we're going to do next week. Thank you.
What? Did you?
I just got the one that I just took.
Oh my god.
My friend was like texting, he's like, oh, they just came out, and I was like, I don't want to
Wait, have
open
a
this
sign
in
issue?
class,
Yeah.
but
Open.
I saw Spartan, and I was like, oh, that's
No, you got it, dude. You
I
got it.
forget to click that, and it says, but then I was
Nice, nice,
But I was
nice.
Oh my god, I would be so scared. I could never check during class.
I don't know the score yet, it's coming out tomorrow, right?
Oh, it just tells you if you have.
Yeah, I feel like that's all.
No, I
that
didn't
matters.
even know
It's
the.
like the day before, there's my friend.
That's so weird. Professor. Professor.
What is past 75?
Yeah.
Professor.
My friend texted me like, oh, they're out, like, do you want me to leave class? And I was like, oh, no, because I knew it was for something, I was like, I want to check.
I'm gonna leave my like a quick HR screen and I'm like, the next class I'm like 11:30, so I'm just like on my phone. Yeah, you got it, man. 2 more.
I'm like,